Hey everyone, me Kevin here. Welcome to a discussion of what the Federal Reserve just mentioned in their minute meeting notes from September. This is going to be our look into what they're thinking in terms of what's holding the economy back and what's propelling things like inflation. One thing I noticed is that the discussion in this minute meeting notes was a lot more hawkish. In fact, I wrote that on top, a lot more hawkish than the prior reading or prior sort of minutes, which are just the meeting notes of what came out of their meetings. Very much of this, and it's worth noting this before we go into some of the details of what they actually said. It's worth noting that a lot of the commentary in this has to do with the potential for COVID holding us back. So they're kind of saying, hey, like, we're seeing inflation going up, but COVID might hold us back. Or we're seeing supply shortages, but COVID might change these dynamics. And what's very interesting about this to consider is that COVID has started to plummet. Like, COVID cases are falling, which would mean that if the Fed's talking about upside risks, as you're going to see in this report, and their really only downside complaint is COVID to maybe keep inflation down, but COVID cases go away, then you could potentially just see more inflation and this potentially more hawkish attitude from the Fed, which might mean that faster tapering or faster rate increase. So let's take a look at some of the notes here and then draw some kind of conclusions with some of the latest interviews and that we've watched and commented on. So let's take a look here. So COVID. See, this, they even start about this, right? The spread of the Delta variant of COVID-19 weighed on the near-term growth outlook. Right. But again, you take COVID out of the equation because we're starting to see COVID cases go down. And hopefully we don't see an explosion in COVID cases in the winter. Then we could potentially see revisions up in terms of GDP, which means no stagflation. It could just mean more growth and potentially more inflation, which is obviously different from having inflation without growth. Stagflation's bad. Nobody actually thinks that we're going to the stagflationary direction at the Fed, but they're definitely seeing at the moment growth potentially slowing a little bit, at least in September, because of COVID, while inflation is still moving to the upside. So, as they mentioned here, and revised projections up for inflation this year, and they mentioned many times that they sort of are seeing that inflation is definitely lasting longer and it's larger than they originally projected. This was interesting. About half of respondents to the desk surveys of primary dealers and market participants viewed December as the most likely timing of the first reduction in net purchases, although respondents also attach significant probability of the first reduction coming in November. So this is where some analysts are guessing, okay, so we'll probably hear that at the beginning of November, the first week of November, we're probably going to see the Federal Reserve say, we're going to taper. Then they'll probably start that taper either the middle of November or the middle of December. It doesn't happen right when they announce it. They kind of schedule it out. It's worth noting. And the Federal Reserve, later in this, they're actually somewhat concerned that the market's going to think that if the Fed starts tapering, that the Fed's not being accommodative anymore to the economy. They saw that as a downside risk, and we'll see that in a moment. But really what that means is, if you think about it, if the Fed right now is buying $120 billion worth of bonds and they drop this to 100 to 80 to 60 and they drop this down over time, these are still accommodations to the market. So there were some discussions about concerns that, hey, if we start tapering, is the market potentially going to think we're not being accommodative anymore? And could that potentially slow markets in the economy? Because that's what they don't want to do. They want to still make sure that businesses are empowered and encouraged to hire people, hiring being something else that we're going to talk about in just a moment here. So let's get to some of the juicy things. Lots of talk about bottlenecks. Obviously, we know inflation has been rising, especially amongst motor vehicles. They mentioned real huge lack of supply here, temporary issues, things like hurricanes or whatever. But inflation abroad, and this is especially in developing economies, inflation abroad was elevated, reflecting reversals of price declines in the early part of the pandemic, past increases in energy and commodity prices, upward pressure from supply bottlenecks, and then you have changes in exchange rates. So in other words, it's not just us seeing inflation, it's other areas like Southeast Asia seeing inflation as well. And it's worth noting, and I think this is so important to remember, that almost every time when we look at an earnings report for some of the companies that are affected specifically by inflationary concerns, almost every time they respond to analysts and they say, look, we are only able to pass about 50% of the price increase along to consumers. And this makes sense because you don't want to raise prices too quickly, otherwise you become uncompetitive. So businesses have to raise prices over time. So in some sense, even if inflation were to actually start inflecting down, that could potentially just be a signal for businesses to raise prices because consumers might be able to now pay those higher prices, or other businesses have caught up. Now you raise prices more to try to get to 100% pass through, which ultimately that's what a business wants. If a business is selling, mugs, and they used to sell them for $10 and make a $5 profit. Now they're selling them for $10, but they're only making a $3 profit. They want to get back to that $5 profit, right? So they got to get this price up by a couple bucks, maybe even fractionally more than that. But maybe they're only able to raise the price $1 now. And so that's what we're seeing in inflation statistics now, which actually means there's more to come, which is kind of interesting to think about it that way, because it's certainly the opposite of what the Federal Reserve has been thinking. The Fed has thought, look, we're going to have base effect inflation, where we're going to be comparing to the whole. And on top of base effect inflation, we'll have inflation when we reopen. But we're having much more than that. We're literally having companies not only paying workers more, but paying more money for products, raising prices for input products, right? Raising prices on the goods and services that they're selling. And we don't really expect those prices to come back down. They might level off, but we don't really expect those prices to come down. So people are going to be paying more for longer. And so we're consistently seeing the Federal Reserve here essentially flip in favor of saying, okay, yeah, we're probably still going to be up against inflationary concerns for another year, maybe even longer. And so we'll see some of that here. They do, as we get into some of the earlier pages here, they do talk about concerns over a potential default by Evergrande and risks of a contagion basically being limited on America and the broader financial picture. So I thought that's always nice to kind of at least hear that. Although who knows, maybe they're lying through their teeth, right? Credit quality for large non-financial corporations like in banks, like not banks, was very strong, remained positive. Lots of upgrades, more upgrades of credit ratings than downgrades. You want to see this. However, you did see that small business owners, especially in COVID-sensitive sectors, they said, like in food services, arts, entertainment, recreation, educational services, became more pessimistic about their financial prospects, largely because of worsening near-term expectations for sales and general business conditions. So everything goes together in business conditions, right? It's politics, it's COVID, it's supply chain disruptions, it's wait times. All those frustrations go together and hurt small businesses. So I think small businesses and consumers are really getting beat up here the worst. Investors are actually doing pretty well, given the fact you look at the stock market. It's just so disconnected from the reality of what's happening out there, mostly because we have so much money printing that's been happening, right? But anyway. Increased concerns. So again, this to me, very interesting. They keep referencing this increased concerns about Delta in August. That's really the only downside risk they see to the economy right now. And they keep saying this over and over and over again in this report. But wait a minute. That's going away now. You look at COVID cases and they're plummeting, which is great. I'm very happy about that because nobody wants to deal with COVID. Everybody's done wearing masks and we're tired about hearing about vaccines and all the madness. But if we do a quick search here for COVID cases, let's see here. COVID cases, United States. Let's just do a really quick look here. Thank God, we're plummeting, which is good. We want this. Now, the last thing we want is to see northern states, once things start getting colder, to start seeing spikes again. That would be bad, right? We don't want to see that again. So it is still a risk. And in a weird way, if we get a COVID spike in, let's say, November, December, January, February, that's actually going to temporarily push down inflation again. While it may push down inflation, it potentially will create more inflation on the back end because you'll exacerbate supply chain issues. So again, you have a COVID surge, people spend less money, people save money, they stay indoors more. You then come out of it, you spend money again, you're still stuck with the supply chain constraints. So really, if anything, if COVID comes back, it would just be a delaying of essentially the more inflation that we're seeing. Okay, so accommodative conditions for borrowers of residential real estate. We know that. Here we go. So the staff's near-term outlook for inflation was revised up further in response to incoming data. at least they're being fluid about it, right? At least they're not like, no, it's going to be my way. At least they're fluid about it. And this is really basically their way of saying, yeah, when we said transitory being like the end of 2021, we actually meant the end of 2022 for inflation to rotate down. The 12-month change in total and core PCE, well above the 2% in July. Available data suggests that it had remained high in August, and obviously we know now it remained high in September as well. Staff interpreted the inflation data as indicating that supply chain constraints were putting a larger amount of upward pressure on prices than previously anticipated. In other words, this is where the Fed is literally saying, oh crap, we were wrong. Inflation's lasting longer. As a result, projections holding steady. Okay, let's see here. The staff continued to judge that risks to the baseline projection for economic activity were skewed to the downside. Now, this is what I disagree with. So the staff together, they're saying, well, we still have risks to the downside. Yeah, if you think COVID's going to get worse. But if COVID gets better and we don't have that COVID surge in the winter, you're going to have upside risks to the economy, which means, again, GDP growth and the potential for even more inflation temporarily. And now when I say temporarily for the sake of this, I do think it's going to be, a while. 6 months, 12 months, 18 months before we deal with supply chain issues. Prices, in many cases, will still keep going up. And I recognize this as a shift. And it's just because the more you go out, the more you're realizing like, oh my gosh, airlines, they can't figure it out. People who are hiring, they can't figure it out. Businesses who are hiring, they can't figure it out. It's hard to hire. There's so much business to do, but it's hard to actually function. So the whole economy has been so effed up, essentially. Or manipulated, or whatever the cause is. It's just all a disaster. Anyway, in particular, but I mean, it's also worth noting that even though if COVID is their version of a downside risk, it's worth also mentioning that if COVID goes away, then we lose that downside risk, that they're not really forecasting any kind of recession, right? So this is where, like, yeah, you might be like, yeah, okay, yeah, we know more inflation coming. Does that mean the market's going to crash? That's not what the Fed's saying. The Fed's saying, yeah, we may have been wrong about inflation, but if anything, it just means the economy is actually functioning right now, and or at least we're trying to get back to proper functioning, and it's because people are spending money like crazy because they have crazy amounts of money. But no alarmism regarding the potential for a market crash, at least not from the Fed. And who knows, it could always be misleading. But anyway. The staff also continued to judge the risks around possible inflation tilted to the upside listen to this, and this was in September, okay, with the possibility of more severe and persistent supply issues, especially viewed as especially salient. So this is a big line right here. More severe and persistent. Okay, so more severe temporary supply chain crises. Persistent would mean it just continues and continues and continues. That word choice actually very, very important. In addition, the staff pointed to a risk that longer-run inflation expectations would move appreciably higher and lead to, here's that word again, it's a big word, and lead to persistently elevated inflation. I mean, this is like a big old U-turn from the Fed here, right? Because now Jerome Powell always said, hey, we think inflation's going to be temporary. We don't think it's going to be persistently higher. We're going to have that reopening inflation, and then, things are going to settle down. Yeah, well, that's a little bit U-turned now. Now we're like, oh, crap. This is lasting more and larger than we expected, which is, of course, the perfect place to insert that's what she said. But anyway, participant views on current economic conditions. Okay, so we talked about this. Likely outcomes for GDP, the unemployment rate. We've seen this in the summary of economic projections before, so there's not much to talk about so much here because we've talked about this before. We did see a mark down of real GDP growth for the year, pointing to a reassessment of the severity and duration of supply chain constraints. Remember, when you can't spend money because you have to wait longer, or you get frustrated and you decide not to buy something, a new refrigerator, a vacation, or whatever, you're robbing GDP. Right? So the supply chain issues, it's not just a matter of inflation. You're also robbing from GDP. I personally do think, though, that as the effect of the Delta variant goes away, we'll still see a return to GDP, more growth than what we're seeing now. We'll probably see revisions to the upside, but those revisions will be done at higher prices, meaning higher inflation. So I don't see stagflation. Definitely do see inflation, though. In the discussions of the household sector, participants noted that consumer spending had decelerated in recent months. But again, this deceleration was really because of Delta, right? See, they even say it here. The Delta variant was weighing on spending for consumer services. And it always goes back. That's why I keep mentioning it. It goes back to this right here. The beginning of September, you were still at peak levels of COVID. You were still at peak levels of COVID through about September 7th. That's only about 36 days ago at this point, right? So, all right, continuing on over here. Nonetheless, participants expect the accumulated stock of savings, the release of pent-up demand, and progress on vaccinations to continue to support household spending. See, they're being transparent. They're like, yeah, sure, right now things are a little bit constrained, but we think that spending is going to come back, which, if anything, that spending coming back after the Delta fears go away, as they are now, just reiterates more inflation, right? Which is not good for inflation purposes, which basically means buy crypto, which finally started going up again. It was so weird that this morning when this inflation report came out, crypto started going down. I'm like, this doesn't make sense. Crypto should be going up. I have a bigger crypto position right now than I ever have had before. I'm at like 6% of portfolio right now, even I think slightly above that. All right, let's see. Respect to the business sector, participants observed that firms in a number of industries were facing challenges keeping up with demand due to a spread of supply chain issues and labor shortages. And like, this is big. If you are a business, well, if you're a business owner, you probably already know, but let me put it this way. If you're not a business owner, you got to picture the implications of this. You're a business owner and people are like, Kevin, we want to hire you to do stuff. We want to hire you to make stuff. But you're like, I can't. That's frustrating as a business owner because you want to service your customers, but you're getting reamed because of these bottlenecks, creating challenges for a number of manufacturers, especially acute for the motor vehicle industry, which is also a shocker how well Tesla is getting through this. It's pretty crazy. I mean, look at this. It's right now on CNBC, supply chain struggles and a picture of a semi-truck, right? It's the same thing, continuing on and on. A couple of participants noted that inventory to sales ratios were at or near record lows in many industries, and the need to rebuild them would boost business investment. See, this is something that actually contributes to GDP, is businesses investing in new machinery, in new trucks, in more efficient products and whatever, manufacturing products or supply chain management. That's big. All right, let's see. A couple of other participants noted that elevated crop prices were continuing to boost income in the agricultural sector. Labor market conditions had continued to improve, but were still below. One thing they mentioned, look at this. Various participants suggested that a complete return to pre-pandemic conditions was unlikely, as the pandemic had prompted reductions in the workforce that were likely, there's that word again, to persist, including a large number of retirements and other departures from the labor force. This right here, in my opinion, means the Federal Reserve is saying, look, we need to worry less about jobs. The labor force participation rate is going to be lower after the pandemic because we just let more people retired. As they said here, people's careers have changed. Maybe they're working from home. Who cares? Whatever. Working, for themselves or whatever. Which I suppose they'd still be considered part of the labor force if they were working for themselves. But whatever. Point is, we've made this analysis before here on the channel that if you're Apple and you lay off 20,000 workers in March of 2020, and then you come back and hire 10,000 of the most efficient people back, well, great. You just shaved your labor force 10,000 people. Your company is now much more efficient. Your margins go up. You're putting more work on individual people, but you have less net people, less net workers, right? And the Fed here is basically saying that's probably going to last. And that will be what continues to weigh on labor force participation and the labor force participation rate. And that basically, we just shouldn't even be paying that much attention to labor force participation going up because it's going to stay low, especially for women with young children and people with lower incomes. Generally under that $40,000 income is what they consider as being lower income. So we're going to see that, which means they're going to have more of a focus on inflation rather than on unemployment. Most participants saw inflation risks as weighted to the upside because supply chain disruptions and labor shortages might last longer and might have a larger, more persistent effect on prices and wages than currently assumed. And this is interesting. Look what they wrote here. Most see upside risks to inflation, but only a few commented that there were downside risks for inflation. like the existing long-term effects that we have in place since before. And those are the deflationary effects of technology, for example, or an aging population. Okay, so then we have, let's see, I'm just going to get to most of the, just generally the highlights here. Labor force participation lagging, but despite labor force participation lagging, remember what they say here, on the basis of cumulative performance, this, whatever, basically, substantial further progress toward maximum employment had been met. So even though you're seeing that lag in labor force participation, they're saying, hey, look, substantial further progress has been met, because we got to start preparing to be able to raise or to taper, and to be prepared to raise rates if we need to. See, several participants, indicated they prefer to proceed with a more rapid moderation of purchases than described in the illustrative examples. So in other words, you know how they do like the dot plot with like the raising of rates, or, hey, when should we taper, whatever? They're basically here saying, hey, we kind of think, forget about the charts. We want to taper sooner and faster. And this is where we really think there's this, and we talked about this a little bit yesterday, where we think that the taper could come to an end, a conclusion, as soon as potentially April to May. The current forecast is that we might end somewhere between June and August. Some have suggested maybe as late as September. This is all being, of course, 2022. So this orange section here is kind of the current, but we're seeing a lot more talk at the Fed about maybe getting this taper done earlier, like in that April-May timeframe. So, and then of course, commencing in either mid-November or mid-December. You could see it directly from the Fed right here. They're being extremely clear about this taper coming. So there should really be no surprise in the market. Risk management considerations, number of downside risks. Again, all of the downside risks, or anytime they mention downside risks, it's always COVID-19. But honestly, once you take away COVID-19, you don't have that many headwinds left. They do give 3 headwinds. They give potential tightening of financial conditions. This would imply that banks are potentially less willing to lend. We're not seeing that right now. We're seeing businesses being somewhat unwilling to borrow, but banks are extremely willing to lend right now. So we're not seeing this first one here. We're not really seeing that as a risk. The second one is COVID, but cases are going down for that. So we're not seeing that as a risk as much. And number 3, you've got the headwind of maybe less stimulus coming from Congress providing a headwind for the economy. But quite frankly, I mean, we have the child tax credit. We're expecting to potentially expand that. I don't really see that as a headwind. I mean, maybe less PPP and so on and so forth, but I don't know about that. So let's see here. Okay, so then we have more persistent inflation, more persistent supply chain shortages. Oh yeah, see, this was that part I was talking about earlier where I mentioned that one of the downside risks to inflation included the possibility that a decline in inflation expectations might occur if the public assumed the Fed was actually being less accommodative than it really was. So I thought that was kind of an interesting mention. No direct signal about interest rate policy, but they do expect to be at or near the lower bound of interest rates over the next couple of years, which would be through kind of mid-2023. That doesn't mean no interest rate increases, just means low rate increases. And this makes sense because for 2022, remember, we're expecting to go to 0.25 to 0.5 in 2022. And then in 23 at the beginning, probably like Q1, we'll go to like 0.5 to 0.75, and then 0.75 to 1, maybe by like Q2 of 23. And we might even go to like 1 to 1.25 by Q3 of 23, sort of the expectations right now. Okay, any other comments here? A little bit about the counterparty upping what they'll take at the repo markets. We've talked about that before in the reverse repos. The Fed will now take up to $160 billion per bank or depositor. That was it. So this kind of gives you this overarching view here of the Fed that, yes, there is more inflation. Yes, it's more persistent, and it's probably likely to continue, quite frankly, for another year, which is kind of crazy to think about, that these supply chain shortages are going to keep going for a year. Businesses, however, are much more efficient. debt and liquidity is very, very high. Household liquidity is very high. As long as COVID doesn't come back, we don't really have a big negative catalyst. And so this is where I've regularly talked about over the last 6 weeks on the channel here, like, what negative catalyst do we actually have for a market crash? Like at this point, saying, oh no, inflation's going to go up. Really? Like, okay, we've heard that a million times before. Like, tell me something else that's new. And I think that's why we've had the S&P today really just brush off this this inflationary data, because it's like, okay, we know, big deal. Like, give us some other news. I mean, look at the indices today. In fact, seriously, look at this. Look at this. The Dow Jones Industrial is flat and the S&P is nearly flat. But look at what's not flat. It's the NASDAQ Technologies up 5.6%. So in other words, companies that would be sensitive to inflation, like expensive companies or lower earning companies, are going up. Hey, look, shout out to Hippo Holdings, up 5.46%. Let's go. They were way oversold. Where's Owlet? Let's get Owlet up here. I know a firm's kicking butt. Look at that, 4.45%. Trade Desk. Dude, you do not invest in a firm or trade desk if you think that inflation is going to kill the economy, right? I think the market has just gotten to this point where, we got enough money, whatever. I'd rather be invested than not invested. And the negative market catalysts have kind of evaporated. It's scary to say that. And I don't want to come across as like blind to potential negative catalysts, right? And so this is why always subscribe to the channel. Join me in the Stocks and Psychology of Money program, a link down below, or the other programs. You can bundle up. Use that coupon code before the 29th because pricing is going to go up. New lectures coming out on the 24th in the stocks group. And really, this is just the market that it makes more sense to buy and then wait than to sit around and wait, because the crashes that we've had have been minor. I mean, I plowed like $4 million into the market over the last like 3 weeks because we had a dip as recently as about a week ago. We've had lots of dips, but beyond, now it's like, now we're going back to the moon. And it's really because, again, the negative catalysts are gone. The only negative catalyst you just saw from the Federal Reserve, literally the only one from the Fed, was Delta. And all you have to do is type COVID cases into Google to realize, well, crap, that ain't that much of a negative catalyst. So Jolly Anderson says, I still see market margin as a possible doomsday negative catalyst. I agree with that. I do think there's a lot of extra leverage in the market right now. I think that is a red flag to pay attention to. I don't know if I would go as far as saying like this is a market crash catalyst yet. But yeah, there is more leverage in the market. I'm not happy about that. And in this kind of market, I would highly encourage you to get out of leverage. Take some tendies on some options that you have or some stocks you have, pay down your leverage, and just be happy. Okay? All right. Thank you so much for watching. Subscribe. Check out the programs linked down below because why not? You get lifetime access. And there's no like, sometimes people ask like, Kevin, if I buy one program, you're going to upsell me to another? Nope. What you get is what you get. There's nothing that you get upsold to, and you don't have to renew your subscription or anything. It's nothing like that. So you pay once, you're in for life. So check out those programs, and folks, I'll see you in the next one.